Do you want to supercharge your investing game? If yes, then you are in the right place. In this video, you'll learn about the 7 biggest and common mistakes almost every investor makes, straight from the legendary Warren Buffett himself. You will also know the best tips and tools for reaching financial freedom through stock market investing. Hey everyone, welcome back to our channel. If you ever made a decision you later regretted or felt baffled by the market, you're not alone. Even the billionaire investors like Warren Buffett and Charlie Munger have faced drawbacks. Get ready to explore the 7 mistakes that every investor makes so that you can avoid them. 1. Timing the market. Believe it or not, even investing legends like Ben Graham failed while trying to time the market. Concentrating too much on market movements is a big mistake. Why is predicting market movements so alluring? Because the tide can raise or sink all ships. You pick a great stock, then COVID strikes, another awesome company, and suddenly facing rising interest rates, inflation, and war. What the hell? You all wish to purchase the dips and sell the highs, right? But Warren Buffett advises investors to only concentrate on 2 specific things, the important and the knowable. Where the market is heading is important, but is it knowable? Nobody knows what interest rate hike Jerome Powell will declare next, and frankly, I don't think he does either. So what does Buffett do? He focuses on what is both important and knowable, identifying better stocks at fair prices. Recognizing a better stock is far easier than predicting every storm into the future. This is how you'll do good by betting on the best businesses. 2. Getting attached to your purchasing price. Ever felt a stock's price was judging your past decisions? It doesn't. Your stocks do not care what you paid for them, making the past irrelevant for future returns. As Buffett puts it, a stock at 50, somebody's paid 100, they feel terrible. Somebody else paid 10, and they feel wonderful. All these feelings, and it has no impact whatsoever. Imagine 3 investors. Arnold purchased Amazon lately, up 5%. Ben purchased a year ago, down 38%. Katie purchased 5 years ago, up 133%. Should they treat the stock differently? No. The only thing that matters for today's decision, keeping or selling, is how the stock will perform in the future. If Amazon sells for 50% more in a year, all 3 make 50% from today's level. But many investors get attached to their purchasing price. But a stock doesn't care about your entry point. Warren Buffett recommends to pretend to always have a blank slate. 3. Aggressive growth projections. Expecting double-digit growth from large stocks is a plain delusion. Many highly valued companies try to defend their stock price by forecasting exceptional growth. Believing in aggressive growth projection is a mistake. Anytime you buy a stock at, say, 20 times earnings or more, you need earnings to grow drastically for amazing return. And that's not easy. Among S&P 500 companies from 2012 that still exist, only 1 in 10 managed to grow at 15% or more. Recognizing a 1 in 10 company is incredibly difficult. 4. Using a lot of leverage. Here is a quick fact for you. Borrowing money is the fastest way for a smart investor to get into trouble. Gets into investing trouble. The only way a smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. Using a lot of leverage is the financial equivalent of playing Russian roulette. It screams desperation. Why is it so dangerous? Because if you borrow money, you can be right about something, but you might not be allowed to play your hand, so you'll lose anyway. Take Harry the hedge fund manager shorting GameStop. He uses leverage. Even if GameStop's valuation is unsustainable and Harry is right, if the stock spikes temporarily, his broker issues margin calls. If he can't cover them, he's forced to close his position at a loss. Harry could be proven right eventually, but because he used leverage, he was forced out of the game. Investing is not a game for a chicken-hearted or impatient. 5. Missing the forest for the trees. According to Warren Buffett, only 3 things matter in investing: the future economics of the business and its industry, the management, and the price. If you get these 3 right, you don't have to worry about every minute detail. Buffett can supposedly make a deal in 15 minutes, not because he understands every single minute detail, but because he grasps these 3 core aspects. Getting caught up in too much detail can make you miss the forest for the trees. Hence, you should only focus on what is most important instead of getting occupied with every tiny detail. 6. Jumping over 7-foot bars. Unlike other areas of life, in investing, the difficult route is not always the most profitable. Some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all. Committing this mistake is common because it goes against how success is often defined elsewhere. People are often rewarded for tackling difficult challenges, but in investing, difficult predictions or complicated mathematical acrobatics are not only unrewarding but often disastrous. Just ask the geniuses at long-term capital management. This relates back to missing the forest for the trees. If you can find a good stock with honest management, favorable industry prospects, and you don't overpay, you are bound to do well. Simple ideas yield amazing results in the long run in the investment world. You don't have to pick the most complex or impressive investment. 7. Shrinking your universe of opportunities. Know this: limiting your investment choices to a narrow sector or niche might cost you massive gains. Opportunities do not stay in the same place for too long, and you never know where they'll show up next. Therefore, it pays to have an open mind and not limit your possibilities to, say, a single sector or industry. Many funds do this by focusing only on high dividend, ESG, or crypto companies. Opportunities don't work like that. Fund managers often know this, but niche marketing makes their products easier to sell. These are the 7 deadly sins of investing, according to Warren Buffett. Avoiding them can significantly improve your long-term success. Do you have any other common investing mistakes you've learned to avoid? Share your experience in the comments. If you liked the video, give a thumbs up, share it, and subscribe to our channel for more such interesting videos.